What's up everybody, Gen X Dividend Investor here. In this video I'm going to share reasons why you should never buy some specific dividend stocks, as well as highlight various investing strategies you might want to avoid as well. But before you watch this video, I ask you to leave me a comment telling me of any stocks you refuse to buy, or perhaps any industries that you won't invest in, or are there any investing strategies you aren't interested in trying? Some folks might not understand what I'm talking about when I'm saying investing strategies, so I'll quickly go over a few. A big one is value investing, which focuses on buying undervalued stocks, trading below their intrinsic value, and popularized by Buffett. Another well-known one is growth investing, which concentrates on companies expected to grow faster than the overall market. My favorite investing strategy is dividend investing, of course, which for me involves investing in companies that have a consistent history of paying out more and more dividends over time. Some other strategies include momentum investing, which aims to capitalize on existing market trends by buying securities showing upward momentum and selling those with downward momentum. And there's contrarian investing, which focuses on going against prevailing market trends, such as buying stocks during downturns when others are selling, as well as looking for assets that may be temporarily out of favor. Another well-known strategy is based on technical analysis, which uses price charts, patterns, and technical indicators to predict future price movements, often used by traders for short-term investment decisions. And there are other strategies like dollar cost averaging, buy and hold, sector rotation investing, socially responsible investing, and environmental social governance investing. But a strategy I'm not a big fan of is shorting stocks, and I got this comment today which speaks to it. They said, if a dividend can't pay me more money than I can make from shorting the position, then it's honestly just wasting life away. They left that comment on my recent J&J video, so for them J&J must be a stock that they apparently would never buy. Their view reflects a preference for a more aggressive investing strategy that can potentially generate higher returns faster, rather than waiting for dividend payouts and stock appreciation. And for those that aren't familiar, shorting a stock involves betting that its price will decline, and shorting can potentially offer quick, substantial gains if the stock's price drops significantly. If the stock price instead rises, then your losses can theoretically be unlimited because there is no cap on how high a stock's price can go. In contrast, when you buy a dividend stock, the maximum you can lose is the amount you invested, assuming the stock goes to zero. Plus, shorting a stock generally requires borrowing shares from a broker, which means you must have a margin account. The broker will typically require you to maintain a certain amount of equity in your account, and if the stock price rises, you may receive a margin call and be forced to deposit more money into your account or close out your position, potentially at a loss. There are also going to be fees associated with shorting, including interest on the borrowed shares and possibly fees if the stock is hard to borrow, like if it's in high demand for shorting. And beyond that, if a company pays a dividend while you're short the stock, then you're responsible for paying that dividend to the entity you borrowed the shares from. Additionally, stock splits, mergers, and other corporate actions can affect your short position in ways that are not necessarily in your favor. Moreover, risky things like short squeezes can happen, which is when a heavily shorted stock experiences a sharp price increase, forcing short sellers to buy back shares to cover their positions, which further drives the price up, all of which can cause massive losses for short sellers. The famous GameStop short squeeze in 2021 is an example of how quickly shorting can go wrong when a stock's price rises unexpectedly due to high buying pressure. And there is a timing risk to consider with shorting. Like, even if your thesis about a stock's decline is correct, the timing may not work out in your favor. The stock could stay overvalued for longer than you expect, leading to ongoing costs and potential losses as you wait for the price to drop. So while shorting can offer quick profits in certain markets, the risks are substantial when compared to simply investing in boring blue-chip dividend stocks. But that doesn't mean shorting a stock is bad or doesn't have its place, as you can make incredible returns if you're willing to take the risks. I don't like to short, but one of my friends, who was actually my best man at my wedding, ended up making the majority of his net worth by shorting the market right before the dot-com crash. He worked at a large financial firm helping people to invest, and was successful enough that he quit and started his own wealth management company. These days he spends more time skiing all around the world than working, but I prefer the slow and steady approach of buy and hold dividend investing, which tends to have a good track record over the long run. And speaking of the long run, over the last 5 years on social media, I've gotten the opportunity to hear lots of perspectives on different investing approaches, as well as on different dividend stocks. For example, a few hours ago I got this comment on my J&J video where the person said that J&J is not in their portfolio simply because they're focused on income investing and J&J's dividend yield is not high enough for them. So that's another reason why someone might not buy J&J. Now, I'm not someone who says that you should only invest for total returns, because people's needs and risk tolerances and timeframes for returns are all different. Maybe you want to own bonds rather than stocks, perhaps because you're older and want to have less risky investments. Sure, over the long run, at least historically speaking, equities have outperformed bonds, and I personally don't own any bonds myself, but that doesn't mean you can't or shouldn't. My goal with my channel is to advocate for people to invest, focusing on my experiences primarily with quality dividend stocks, but I'm also trying to teach people how to research broad financial topics to help them forge a financial path that makes sense to them. So my hope for that person who is focused on income investing instead of J&J is that they understand the pros and cons of their strategy. I mean, focusing on stocks with higher dividend yields can make sense for income-oriented investors, especially if they have specific goals and preferences. Some investors, especially retirees or those living off dividends, may require higher levels of income to cover living expenses. And a higher yielding stock can provide more cash flow right away, making it more suitable for meeting immediate financial needs without having to sell shares. And of course, income investors often prioritize cash flow over capital appreciation. For them, the goal is to generate as much income as possible from their investments. In their case, higher yielding stocks can be more appealing because they offer significant dividend payments, which can be reinvested or used for expenses. And I've seen some income investors set specific yield thresholds when choosing stocks. If a stock's dividend yield falls below a certain level, it may not meet their income criteria, even if the company is fundamentally strong. So Johnson & Johnson, with its modest yield, might not fit into such a strategy if the investor's threshold is higher. Plus, a higher yielding stock can offer a quicker return on the initial investment through dividends. For instance, if an investor wants to recoup their investment over a shorter time frame, stocks with higher yields can facilitate that more quickly compared to lower yielding stocks like J&J. Now, J&J is often considered a dividend growth stock, meaning it offers consistent dividend increases over time, even if the starting yield is relatively low. Plus, some investors are comfortable with the higher risk associated with higher yield stocks or ETFs. They may be willing to accept this risk to achieve higher yields, which can be a different approach from investing in stable, low-yield dividend payers like J&J. And of course, certain sectors and industries traditionally offer higher yields, such as utilities and telecoms and REITs. If an investor's strategy is to focus on these sectors due to their yield characteristics, then they may exclude lower yielding stocks from other sectors, regardless of the company's quality. While that approach can suit certain investors' needs, it also involves trade-offs, such as potentially higher risk or less dividend growth over time. Though again, for those who prioritize immediate income generation, the strategy of focusing on higher yielding stocks over a lower yielding blue chip company like J&J can align well with their financial goals. But there are also reasons why it might not make sense to be an income investor. Like, one of the most common mistakes is prioritizing high dividend yields without understanding the associated risks. Stocks with extremely high yields often signal financial trouble or declining business fundamentals. And if a company's dividend is unsustainable, it could lead to a dividend cut, causing both income loss and capital losses as the stock price falls. So focusing solely on dividend income can cause investors to overlook total return, which includes both dividends and capital appreciation. And while dividends provide a steady income, long-term wealth accumulation is often driven by a combination of reinvested dividends and stock price growth. Sacrificing potential growth for a higher yield could mean lower overall returns over time. And dividend yield is just one aspect of income investing. Companies with lower initial yields but strong dividend growth potential, like J&J, can eventually provide more income over the long term as their dividends increase. Focusing only on high yields may mean missing out on these dividend growth stocks that can deliver increasing income streams and appreciation. Plus, if an investor is focused on income investing in a taxable account, they might be generating more taxable income than necessary, resulting in a higher tax bill. In contrast, growth stocks that generate capital gains rather than dividends can offer more tax-efficient growth, particularly if the investor holds them for longer periods to qualify for lower capital gains taxes. And some income investors may get fixated on dividend yield and neglect to evaluate a company's overall financial health and business prospects. Remember, dividend payments are not guaranteed, and if a company's fundamentals are weak, it could cut or eliminate its dividend, eroding the stock's value and future income. I've seen that income investing is often driven by the need for current cash flow, but this short-term focus can come at the expense of long-term growth and wealth accumulation. So younger investors in particular may benefit more from reinvesting dividends and focusing on total return rather than immediate income, which could limit future growth potential. And you can't forget about inflation. I mean, if the yield is high but the company doesn't regularly increase its dividend, the purchasing power of that income can be eroded by inflation over time. Focusing on high yields without considering inflation-resistant income streams can be problematic, as it could lead to a declining real income over the years. Bottom line, it's crucial to assess the sustainability of the dividend rather than just the size of the yield. These factors highlight why income investing shouldn't be approached purely from a highest yield wins perspective. It's important to balance income needs with risk, growth potential, and the overall financial health of the investments. Okay, and what other dividend takers do some people say you should never buy? Well, a common one that frequently comes up is avoiding covered call ETFs, which are funds that use covered call option strategies to generate income for investors. Those sorts of ETFs can also generate some income from the dividends in the underlying stocks they hold. Writing covered calls can help cushion downside risks because the premiums collected offset some losses in the underlying tickers, potentially leading to lower overall volatility. And these ETFs can provide regular income, appealing to income-focused investors such as retirees who are looking for stable cash flows. Plus, investing in a covered call ETF allows investors to gain exposure to an options strategy without needing to manage options positions themselves. Thus, everything has its pros and cons. One con that covered call ETFs tend to have is that their upside can be capped because the written call options oblige the ETF to sell the underlying stock at a set strike price. If the stock rallies sharply, gains above the strike price are not captured. Another con might be that the income it generates may be taxed as ordinary income, short-term gains, or other less favorable tax treatments as compared to qualified dividends or long-term capital gains. Plus, covered call ETFs often come with higher expense ratios than traditional equity ETFs due to the additional management and trading involved in maintaining the options positions. And like any equity investment, covered call ETFs are still subject to market risk. If the underlying stocks decline sharply, the premiums collected may not be enough to offset the losses. Beyond that, during periods of low market volatility, option premiums may be lower, resulting in reduced income potential. This can affect the ETF's ability to maintain its desired higher yield. And just like any dividend stock, if the underlying dividend tickers reduce or eliminate their dividends, then the overall income from the ETF can be impacted. Additionally, writing calls may lead to early assignment where the underlying stock is sold, potentially affecting dividend capture. If the underlying assets are called away, the ETF may miss out on future price appreciation and have to reinvest in potentially less favorable conditions. And they may end up needing to amp up their return of capital when the returns are low, which can work for a while, but if new investors aren't constantly flowing in and if their options and dividends don't yield the returns they want to pay out, and if its ticker price are declining, then all that can lead to declining NAV and ultimately a non-sustainable ETF. Over time, consistent use of return of capital can gradually deplete the ETF's assets. This erosion happens because the fund may be paying out more than it's earning, which can reduce the asset base and the ability to generate future income. If this continues, the decline in NAV can accelerate, kind of like dominoes falling, potentially resulting in a situation where the fund's ability to pay distributions is even more compromised. TLDR, while covered call ETFs can provide higher income through options premiums, they do face sustainability risks, especially in certain market conditions or when cash outflows do not support the targeted distributions. I currently have some CC ETFs, but I'd caution against going too heavily into them. Like, they're only about 10% of my portfolio, and I'd be comfortable going a bit higher given that I'm in retirement, but they're also a type of stock that I'd tell my kids that they shouldn't buy given where they are in life and the fact that long-term I believe they'll underperform the market. But they can be suitable for income-seeking investors, but come with trade-offs in terms of growth potential and other risks. Now take a look at this comment about J&J. They said, pay the 60,000 plus cancer victims of J&J's talc baby powder. If J&J can cause so much harm with their products and refuse to make cancer victims whole, why would anyone buy their medical devices or products? So this person would never invest in J&J because what J&J did in the past and what they're doing now. And I like sharing examples of why people wouldn't touch J&J because it's one of the most popular dividend stocks in the world. My point is that different people have their own reasons why they would or wouldn't invest in something, and that's great because that actually makes a market of supply and demand. My real message in this video is that you should invest in what makes sense to you, regardless of what I say or think, though I encourage you to spend some time to learn about the pros and cons and issues about a company before you decide to own it. Don't buy things if they don't enable your goals and aren't within your risk tolerances and don't fit within the time frame of your return and your portfolio design and such. So I can understand if you don't want to touch J&J because of the talc thing, or maybe you don't want to touch sin stocks like Altria or BTI or Philip Morris or whatever due to the harmful nature of their products. I get it, and I applaud you for investing however you want. And speaking of sin stocks, they may become more growth oriented if MJ becomes more legalized or if their alternate heat not burn products really take off. But they have tons of risks like regulations and changing health perspectives you still got to contend with. Now, one thing a lot of people don't realize is that if you're investing in the SP 500, then you also end up with owning a tiny bit of Altria, which I'm personally okay with, but if you aren't, then you might need to make your own ETF of tickers or whatever. The reality is that it's basically impossible to invest in a public company that doesn't have some controversy about it. I mean, obviously companies in industries like alcohol, firearms, fossil fuels, gambling, nuclear power, tobacco, etc. have obvious aspects which some people find problematic. But I challenge you to name one SP 500 company that is without issues or controversies. For example, take ABBV, a stock that has been very good to me. On the morning I was working on this part of the video, ABBV announced a 5.8% dividend hike. I actually put a poll on my Twitter account where my followers can guess how much they think ABBV would raise their dividend by, and this time the majority of them correctly guessed that ABBV's raise would be between 3 and 6%. And please pause the video and follow me at GenXDividend on X if you haven't yet. Thanks, I really appreciate it. Okay, so ABBV is my fourth largest position of the 28 tickers I own. I have 932 shares of it, and before their raise they were paying me $1.55 a share per quarter, which means I was making $1,444 every 3 months in divvies, or $5,778 a year. Their hike increased their quarterly dividend by 9 cents up to $1.64 per share per quarter, meaning I'd be making $1,528 per quarter, or $6,113 per year, which is about $335 more in dividends annually. That takes my portfolio up to a new all-time high of about $131,000 annually in dividends. So that's good news, but what are some reasons why I've had comments from people telling me that they'd never buy ABBV? Well, one guy said that ABBV was too unethical for charging people so much for their blockbuster drug, Humira. ABBV has faced criticism and legal scrutiny for repeatedly increasing the price of Humira, sometimes significantly. In the US, the price has more than tripled over the past decade, leading to accusations that the company is exploiting its market position at the expense of patients in the healthcare system. The company's pricing practices have sparked lawsuits and investigations by various US state governments, as well as broader public outcry over the affordability of prescription drugs. So I can understand how that might turn someone off to investing in it, but another way to look at it is that a ton of R&D went into discovering and then manufacturing this drug, so the company should be able to make a profit, and without the R&D investments, then this never would have existed. And mind you, lots of R&D investments go nowhere. Like millions and even billions get invested in dead ends. So is their profit too much? I guess that depends on your perspective. I mean, I'm someone who takes multiple meds every day and would die if I didn't, so I can personally understand wanting cheaper prices. But the business and capitalist side of me also understands a company wanting to optimize their returns. And for reference, Humira was developed in the late 1990s and was approved by the FDA in 2002. It was discovered by scientists at BASF Biosearch Corporation, who were later acquired by Abbott Laboratories, which later spun off its pharmaceutical division as ABBV. ABBV has also been criticized for employing a strategy known as patent evergreening, where the company extends the exclusivity period of a drug by filing numerous additional patents for minor modifications. For Humira, ABBV secured more than 100 patents in the US to delay the entry of lower-cost biosimilar competitors. This strategy effectively allowed the company to maintain a monopoly on the drug far beyond the original patent expiration, keeping prices high and limiting access to more affordable alternatives. This tactic has drawn significant scrutiny from lawmakers, healthcare advocates, and regulatory bodies who argued that such practices undermine the intent of the patent system and hurt consumers by keeping drug prices artificially inflated. And then ABBV, through its acquisition of Allergan, inherited legal liabilities related to the opioid crisis. The company faced lawsuits from various states and local governments, alleging that it played a role in contributing to the opioid epidemic by downplaying the risks of addiction and aggressively promoting the use of opioids. Although ABBV did not originally manufacture these opioids, its acquisition of Allergan brought these legal challenges and associated settlement costs into its books. The company's connection to the opioid crisis has tainted its reputation in the eyes of some investors, who may be concerned about the ethical implications and potential financial liabilities. And those types of risks, i.e. having to pay out billions in opioid lawsuits due to an acquisition they made, is another example of a reason why it isn't simple to say that ABBV makes too much money in its Humira drug, i.e. it doesn't make sense to look at its best-selling drug of all time in isolation. You gotta look at the whole company. So is ABBV something you should buy, or is it one of those dividend stocks you should never buy? I guess that depends on if you have too large of concerns when it comes to their business practices or their impact on patients that can afford their drugs or whatever. If you think what ABBV has done is fair and appropriate, then what do you think about that farmer bro guy, Martin Shkreli or whatever his name is, who is infamous for raising the price of a life-saving drug from $13.50 to $750 per pill in 2015? Does that seem okay? It's not exactly apples to apples, but it hopefully helps make my point in the shades of gray and nuance that can come to investing. That's why you just need to make sure that your reasons to invest, whether you're focused on financial things or moral things or whatever, ultimately make sense to you. I don't think you should care if I or anyone disagree with your approach. Sure, understand the reasons that people aren't on board with something you invest in, but in the end of the day, it's your life. And again, every big company in the S&P 500 has controversies that lead to some people never investing in them. For example, let's talk about Warren Buffett's Berkshire Hathaway, because you can't get much more respect in the industry than from someone like Buffett. Berkshire isn't a dividend stock right now, but they invest in a ton of dividend stocks. And hey, it's Buffett, the guy who probably has the most integrity of all the financial titans in the world, so Berkshire has to be squeaky clean, right? Well, that depends. Berkshire has significant investments in the fossil fuel industry, particularly through its subsidiary Berkshire Hathaway Energy, and it has large stakes in companies like Chevron and Occidental Petroleum. But those investments have drawn criticism from environmentalists and socially conscious investors who are concerned about the impact of fossil fuels on climate change. And despite increasing public pressure for businesses to transition to cleaner energy sources, Berkshire has not fully embraced renewable energy or divested from fossil fuels to the extent that some other large investors have. Okay, but aside from that, everything else about Berkshire is pretty pristine, right? Well, even Berkshire's corporate governance structure has been a subject of controversy, particularly its dual-class share system. Warren Buffett controls a substantial portion of the voting power, despite owning a smaller portion of the company's economic interest. This concentration of control makes it difficult for other shareholders to influence corporate decisions or challenge management. And beyond that, you can find dirt on pretty much every company Berkshire holds in its portfolio. For example, take Coca-Cola, a stock I'm long in. Berkshire's long-standing investment in Coca-Cola has drawn criticism due to concerns about the health impacts of sugary drinks and the company's role in contributing to obesity and related health issues. I've personally had multiple people freak out in my comments asking how I can support a company that enables diabetes and obesity and stuff like that. And honestly, I get the perspective. I mean, my dad has diabetes, and so do two of my closest friends. And yet I have Diet Coke in my fridge, even though my wife hates that I drink it, and she won't let the kids touch it, and I'm proud to be a shareholder. I smile each time I see a Coke truck driving along the road. One person's never buy stock can be another person's great investment. And beyond Coke, think about another company Berkshire acquired in precision cast parts. They're a manufacturer in the aerospace and energy industries and have faced environmental violations and lawsuits over alleged pollution and contamination, which some investors view as inconsistent with sustainable business practices. So while many admire Warren Buffett's investment track record and his overall integrity, there is still controversy that causes some people to refuse to invest. Or how about another example of a dividend stock I own in Apple? Apple is one of the most valuable and influential companies in the world, but it too has faced significant controversies that might deter some investors. For example, Apple has faced significant criticism for the working conditions at its suppliers' factories, particularly in China. The company's main manufacturing partner, Foxconn, has been accused of poor labor practices, including long working hours, low wages, unsafe working conditions, and incidents of workers' suicides. Although Apple has made efforts to improve conditions and conduct audits, these issues continue to raise concerns about the company's supply chain practices and the treatment of workers. Labor rights organizations have also highlighted the use of child labor and forced labor in the sourcing of materials like cobalt, which is used in batteries. And beyond all that, Apple has been criticized for its use of complex tax structures to minimize its tax liabilities, which some feel is corrupt. I mean, they've set up subsidiaries in countries with low tax rates, such as Ireland, to reduce their tax burden in the US and other markets. This tax avoidance practice, while legal, has led to public outcry and scrutiny from governments. In fact, in 2016, the European Commission ruled that Apple had to pay 13 billion euros in back taxes to Ireland, arguing that the company had received illegal state aid by paying significantly less tax than other businesses. Plus, Apple has been accused of engaging in anti-competitive behavior, particularly with regard to its App Store policies. The company charges a 15 to 30% commission on digital sales made through the App Store and requires developers to use its in-app payment system. That practice has been challenged by companies like Epic Games and Spotify, which argued that Apple's policies are monopolistic and harm competition. My point in sharing all that is to simply highlight that every company has its issues, some of which will matter to you and some of which won't. Each ticker I own has had at least one person leave me a comment on each of my social media platforms about how they'd never buy it for whatever reason. Heck, I had someone slam me for wanting to own international stocks because that wasn't patriotic enough. I've been told that countries outside the US engage in business practices that are too unethical or that exploit local communities. But the reality is that many US companies engage in things that one could characterize as unethical or exploitative. So are there other dividend stocks you shouldn't invest in? Well, let's take a look at another example of a dividend stock I own in Colgate-Palmolive. I got slammed for owning them because they do animal testing, particularly in their oral care and household products lines. And while the company's made progress in reducing animal testing and developing alternative testing methods, it still conducts animal tests in certain circumstances to meet regulatory requirements. Many consumers and animal rights organizations advocate for cruelty-free practices, and Colgate's involvement in animal testing has led to calls for boycotts. Thus, investors who prioritize ethical standards regarding animal welfare may choose to avoid companies that engage in or are associated with such practices. Beyond that, Colgate-Palmolive has also faced criticism over its contribution to plastic waste since they're a major producer of consumer products like toothpaste, soap, and cleaning supplies. Many of the company's products come in single-use plastic packaging, which contributes to environmental pollution and marine plastic debris. Now, Colgate has pledged to make its packaging 100% recyclable, reusable, or compostable by 2025, but critics argue that progress has been slow and that the company could do more to reduce its environmental footprint. Plus, Colgate has faced scrutiny over some of the ingredients in its products, such as triclosan, a chemical used in its Colgate Total toothpaste for many years. While the company has since removed triclosan from Colgate Total, the past use of such ingredients can raise questions about the company's commitment to consumer safety and product transparency. So is Colgate a dividend stock you should never buy? I don't think so, but that's just me. Another common complaint I hear is that the CEOs of S&P 500 companies make way too much money as compared to the lowest paid workers. If you dig enough, you'll find stuff that doesn't meet your ideals with every company out there. Some can understandably be showstoppers, but I'd also caution you to realize that perfection doesn't exist in investing. If you refuse to invest because no company is perfect, that's like refusing to get married because no person is perfect. And of course nothing is perfect, but can you find something that is perfect enough? Another example of a dividend stock you might want to avoid is if its dividend payout ratio is too high. I mean, you don't want to be left holding the bag if your company can't afford to keep paying out so much of its earnings as dividends. And super high debt is another warning sign that might cause you to avoid a particular dividend stock. Some companies resort to taking on debt to cover some or all of their dividend payment, and again, that can lead to an unsustainable path. Plus, you probably want to avoid buying companies with declining revenue and earnings. I mean, firms with shrinking revenue or profits may not be able to sustain dividend payments over time. Another metric that is a warning sign for me is when a company has a history of dividend cuts. That doesn't mean it's a bad company, nor does it mean you can't make great total returns with it still. It's just something I personally don't like to mess with. I figure that companies that have previously cut their dividends may be more likely to do so again in challenging times. Now, if their cut came from a black swan event, like the pandemic, I could at least understand it more. But the reality is that we'll have lots of more crazy events in life, so hopefully your companies are robust enough to make it through most bad events. The truly strong companies can keep increasing their dividend payouts. Another type of company that I personally usually avoid, at least when I'm looking for good dividend stocks, are smaller companies. Smaller companies usually seem to be riskier, have more volatile and unpredictable earnings, and generally are more vulnerable to market shifts. Another warning sign for me that says don't buy is if the dividend stock is in a declining industry. Now, I'm investing in both sin stocks and energy stocks, both of which have aspects which are in decline, which is why I'd caution younger investors away from them. I feel okay holding them in retirement, but that's just me. And of course, companies in sectors experiencing secular decline, such as traditional retail or print media, need you to be extra careful as well. Those industries face long-term challenges that can pressure cash flow and make sustaining dividends difficult. Dividend cuts or eliminations are common in industries undergoing major disruption. So when you see companies with a consistent decline in industry revenue, or that have high competition from newer technologies, or ultimately negative long-term growth prospects, then you might not want to look at them to be dividend stocks you buy. At the end of the day, I'm not here to tell you what to buy and what not to buy, but I'm instead just sharing my 2 cents as someone who's passionate about investing. I just want you to invest non-stupidly, because I've seen how positive investing can be if you stick with it for decades. I've gotten to a point that my dividends cover all my expenses and more, and it's an incredible feeling to be at that spot, especially because I've also had times where I had no job and did not have enough dividend income, and was worried about how I'd pay the bills. And that actually reminds me of something that happened yesterday. I went grocery shopping with my wife, and as we were in the line ready to check out, there was a lady with a cute little baby in the cart ahead of us, playing peekaboo with me and my wife. I got a phone call from my dad, and so I headed outside of the store to chat with him, and my wife paid for the groceries. About 15 minutes later she came out, and there were tears in her eyes. I asked her what was wrong, and she proceeded to tell me that when the mom with the baby was checking out, she apparently had miscalculated her gift cards and cash on hand and couldn't buy all the things she had in her cart, which were just basic necessities like milk and eggs and baby formula and stuff like that. So the mom started to get out of the line to put some of her groceries back, but my wife stopped her and said she'd buy her stuff. That gesture caused the mom to start crying, which then caused my wife to start crying, which then caused the lady in line behind my wife to also start crying, and then the checkout lady also started crying. And it made me feel good knowing that the decisions and investments I made 3 decades ago have grown to the point where my divvies are helping out some random needy mother in a grocery store. That interaction again reinforced how fortunate I have it in life, regardless of my health realities or challenges or whatever. I mention my health stuff sometimes because I really want to reinforce the idea of loving what you have before life teaches you to love what you've lost. And with that, I'll ask that you please consider helping me out by hitting the thumbs up button, subscribing if you haven't yet, and click that bell notification, as all of that really helps. Please consider becoming a channel member by clicking that join button below, and that's a great way you can support me and my goal to continue educating the world to investing. Finally, don't forget to join my free Dividend Discord chat server, which has over 11,000 dividend investors on it from 83 countries around the world. Thanks for watching, stay positive, and I'll talk to you again real soon. Remember, I'm not a financial advisor, and my videos are for entertainment and inspirational purposes only. Investing of any kind involves risk. I'm only sharing my opinions with no guarantee of gains or losses on investments.